You can have the right investments, a solid plan, and still feel stuck financially if you don't understand how your debt is working against you. Debt is constantly moving. It grows, it compounds, and over time it can quietly limit your ability to move forward. Today, we're taking control of that. I'm Christiana Lovelace. I'm a licensed financial advisor, an accredited asset management specialist, and the owner of Diamond Point Financial. Each week on Pointe Perspective, we step inside the analytical process behind financial decision making, breaking down how professional investors interpret the system and build strategies designed to move with it. Over the last few weeks, we've been breaking down how debt moves through the system, through the markets, and through the economy. This week, we're continuing that discussion. First, we'll look at the market, breaking down how debt-based investments like bonds respond to changes in interest rates and why that mattered so much in recent environments. Second, we'll clarify the difference between deficits and debt and how both contribute to the broader financial system. And third, we'll begin building the foundation of debt management by understanding the different types of debt, how they're structured, and why that matters before you start making changes. Because before you can take control of your financial life, you have to understand how it's built and how each piece is working. Over the past few years, one of the biggest shifts we've seen in the market has been in the value of debt, specifically bonds. For a long time, bonds have been positioned as the more stable, conservative part of a portfolio. They've traditionally been used to provide balance, income, and can act as an anchor during periods of market uncertainty. But before we go further, it's important to understand what a bond is. At its core, a bond is a loan. When you purchase a bond, you're lending money, typically to a government or a corporation, in exchange for a fixed interest payment over a set period of time. At the end of that period, the original amount you invested is returned back to you. That structure is what gives bonds their reputation for stability. You have a defined payment, a defined timeline, and a known return, assuming that the issuer is able to meet those obligations. But in 2022, that assumption of stability was challenged in a way that many investors were not expecting. As interest rates rose at one of the fastest paces we've seen in decades, bond prices declined, some significantly. And for investors who were heavily allocated to longer-term bonds, it has taken a longer time to recover. That created a lot of confusion. People weren't expecting the safer portion of their portfolio to behave in that way. The reason behind that shift comes down to how bonds are priced in the market. Even though a bond has fixed payments, its value doesn't stay fixed. It trades. And when interest rates change, the value of that bond adjusts accordingly. If new bonds are being issued at higher interest rates, older bonds with lower rates become less attractive. In order to compensate for that difference, the price of those existing bonds declines. So even though the structure of the bond hasn't changed and the stated interest payments remain the same, its market value can fluctuate. One of the key factors here is time. The longer the maturity of the bond, the more sensitive it tends to be to changes in interest rates. That's why longer-term bonds experience more volatility during that period, while shorter-term bonds were less impacted. If you're holding an individual bond and you plan to keep it to maturity, those price fluctuations may be less relevant. But for investors who are invested through bond mutual funds or exchange-traded funds, those values can fluctuate more visibly because those funds are priced daily based on market conditions. Now, as we look at today's environment, interest rates remain elevated and there's still uncertainty around where they go from here. That means the value of debt-based investments continues to shift based on expectations around inflation, policy, and overall economic conditions. It's an important reminder that even investments that are considered more stable carry risk, especially when the environments shift quickly. This is also where perspective matters. The issue in 2022 wasn't that bonds stopped working. It's that the environment changed and many portfolios weren't positioned for that type of rate movement. Which brings us back to the role that bonds are meant to play. They're not designed to outperform stocks over long periods of time. They're designed to provide balance, income, and stability within a broader portfolio. But how effectively they do that depends on how they're used and how they're balanced with other asset classes. No single investment behaves in the same way in every environment. Stocks respond to growth and earnings expectations, bonds respond to interest rates, and other assets can respond differently depending on the broader economic conditions. So, to tie that back to what we've been discussing over the last few weeks, rather than relying on one category to always behave in a certain way, the goal is to build a portfolio where different pieces can respond differently over time. Understanding how interest rates affect debt isn't just about bonds. It's about understanding the cost of money and how it influences the entire system, and how that in turn affects the value of the investments you might hold. Over the last few weeks, we've been talking about how debt moves through the system, through banks, through markets, and through policy. This week, we're going to narrow that focus and clear up a commonly misunderstood part of the conversation: the difference between deficits and debt. You'll often hear these two terms used together, and sometimes even interchangeably, but they do represent two very different things. A deficit refers to what's happening in a single year. It's the difference in what the government spends and what it brings in through revenue, primarily taxes. If spending exceeds revenue, the government runs a deficit. The opposite would be a surplus, which has been relatively rare over time. Debt, on the other hand, is the accumulation of those deficits over time. So every year the government runs a deficit, that amount gets added to the total debt. Over time, that builds into what we now refer to as the national debt, which as of filming is estimated to be over $39 trillion. When you hear about increasing deficits today, what you're really hearing is that more debt is being added to the system going forward. And the total level of debt reflects the result of years and often decades of those deficits adding up. As we discussed last week, where this becomes more relevant is in today's environment. That is the cost associated with that debt. Debt isn't free. It has to be serviced, which means interest has to be paid. With interest rates higher than they've been in recent years, the cost of maintaining that debt has increased, which means a larger portion of government spending is now going toward interest rather than other areas. This creates a balancing act. On one side, policymakers are working to manage inflation and economic growth. On the other, higher rates increase the cost of borrowing across the system, including government debt. Deficits tell you what's happening right now, debt tells you what's already been built, and interest is the cost to maintain it. Together, they influence decisions around spending, policy, and long-term economic direction. As we move into May, we're shifting our focus to something more personal: how to manage debt within your financial life. Over the next few weeks, we're going to break this down step by step. We'll look at the different types of debt that exist, how they behave, how to calculate and understand your net worth, and then different ways that you can approach paying off that debt. But before we get into strategy, we need to understand the different types of debt that can exist and how they may apply to you personally. When most people think about debt, they tend to group everything together, but not all debt behaves the same way. Just like we talked about with investments, each type of debt has a different structure, a different cost, and a different impact on your financial life. At a high level, most debt falls into two primary categories: revolving credit and installment credit. Revolving credit includes things like credit cards and lines of credit. These accounts allow you to borrow, repay, and then borrow again, often with variable interest rates. That flexibility can be useful, but it also means balances can carry forward and interest can compound over time if not managed carefully. And this is where understanding interest becomes important. Most revolving debt is quoted using an APR, or an annual percentage rate, but that interest is often applied on a daily basis, which means interest is being calculated on your balance every single day and then added to what you owe. So over time, you're not just paying interest on the original amount, you can actually be paying interest on interest. Installment debt, on the other hand, includes things like mortgages, auto loans, and student loans. These are structured with a fixed payment schedule over a defined period of time. That makes them more predictable, but they still require consistent cash flow and long-term planning. In many cases, installment loans use amortization, where each payment is split between interest and principal over time. Early on, a larger portion of your payment may go toward interest, and as the loan progresses, more of that payment begins to go towards reducing the balance. These types of debt behave differently, they carry different interest structures, different timelines, and different levels of flexibility. Revolving debt is often more sensitive to changes in interest rates and can become more expensive over time. Installment debt is generally more stable, but it's typically longer term and tied to fixed obligations. So when you're evaluating your financial situation, it's not just about the amount of debt. It's about what type of debt it is, how the interest is being applied, what it costs over time, and what role it plays in your overall plan. Once you understand how your debt is structured, how it grows, how it's repaid, and how it behaves, you can start making more informed decisions about how to manage it. Before we finish, I'd like to briefly share an upcoming milestone with you. 5 years ago this June, I announced my departure from my previous firm and started Diamond Point Financial. It was a big step and at times a challenging one, but the support I received from my family and clients has made all the difference. To celebrate, we'll be hosting an open house at our office in downtown Hickory on Tuesday, June 23rd from 5 to 7. I'll share more details in the coming weeks, but for now, consider this a save the date. It'll be open to clients and industry partners, and if you're in the area, I would truly love for you to join us. Today, we took a step back and started to organize how debt works throughout the system. We looked at how debt-based investments like bonds respond to changes in interest rates and why that mattered so much in recent market environments. We clarified the difference between deficits and debt in the broader economy and how both contribute to the system over time. And we started building the foundation of debt management by breaking down the different types of debt and how they're structured. Debt is something that's either working for you or working against you. And while you don't control the markets or the economy, you do control how debt shows up in your own financial life. Over the next few weeks, we're going to continue building on this. We'll go deeper into how to evaluate debt, how to calculate and understand your net worth, and different approaches to paying down debt over time in a way that aligns with your overall financial plan. If this helped bring some clarity to what you're seeing, make sure you subscribe to the channel for new discussions every Thursday. And if you prefer a more concise summary, you can always subscribe to our weekly newsletter, which is sent out every Friday. Or if you'd like to explore how this applies to your own financial situation, you can learn more about Diamond Point Financial using the information below. I hope this offered some useful perspective. Until next week, take care.